Good morning, everybody. Welcome. I'm here with Ben Thorpe, our FD, and Andrew Shepherd, CEO of International Business, who you all know. So we're going to run through a short presentation, and then there'll be time for Q&A at the end, as normal. I'm delighted that this morning we announced the acquisition of the Lloyds Bank International offshore wealth and funds business for up to 9.6 million, funded from our existing cash resources. This acquisition has a compelling rationale for the group, with a high quality client base and FUM of 1 billion, increasing our group FUM by up to 8% to over 13 billion. Now, as you know, over the last few years, we've worked really hard to strengthen our foundations, all part of our strategy to deliver improved returns over the medium term from a growing and scalable business. And we now have a platform for growth and the capability to make and to successfully integrate acquisitions to complement our organic growth strategy. We completed our first successful acquisition with Connellan earlier this year, and our purchase of Lloyds offshore wealth and funds business now builds on this, meeting the high bar that we've set for potential inorganic opportunities, specifically a high quality business, strong strategic and cultural fit, and value adding through strong EPS accretion. Importantly, it's also a very compelling fit with our international business. Andrew's been leading the reinvigoration of International since he took on the role in April last year, has been making great progress, which we covered in March at our half-year update. This acquisition, which further transforms International, accelerates the work already underway. Now, Andrew and Ben will go into more detail shortly, but I just wanted to pull out a few highlights. Firstly, it brings benefits today through increased scale, and also an expanded offering and a broader intermediary distribution base. Also, it brings the potential for future benefits through the partnership agreement being put in place for the cross-referral of clients going forward. So it's great news that we've been able to reach agreement to acquire Lloyds offshore wealth and funds business. It's a good deal for them, for their clients, and for their intermediaries. And it's especially a good deal for us and for our international business, as well as for our shareholders. This acquisition is another significant step forward in achieving our growth ambitions. Before I hand over to Andrew, a quick recap of our strategy. We continue to focus on delivering for clients and advisors, including robust investment performance. Alongside this, we've executed our strategy in a disciplined manner, and we're well positioned to take advantage of the significant and growing opportunities, partnering with IFAs who outsource their investment management. We remain in good shape despite the uncertainty of the current COVID-19 crisis, and we've adapted well to doing business in our new virtual setup. We are well capitalised, and the guidance for our full year that we gave in our Q3 trading statement in April remains relevant. As we look to the future and as the economy starts to recover, these are exciting times for us as a group, as we work hard to achieve and deliver on our growth ambitions. So I'll now pass over to Andrew, who will briefly remind you of the steps being taken to reinvigorate International. And he'll go through why we're so delighted to have announced the acquisition and, importantly, also the future partnership with Lloyds in line with our group strategy. And he'll talk about how this deal will transform International, contributing to its future success as this business becomes a major contributor to the group. So over to you, Andrew.
So as Caroline says, let me initially very briefly remind you where we've come over the last year, which has been a year of real progress for us internationally. First of all, I'm pleased to say that we've had a year of real stability, where we've added real quality to our ranks to bolster what was already a strong team. Secondly, it's been a year of aligning with the group, utilising group capabilities and focusing ourselves on the products which we offer and the distribution of those products. And thirdly, it's been a year of protecting our asset base and of reorganising the business, as most of you have heard me talk about before, focusing on the product range, reducing risk and building momentum with detailed plans in place for all of our distribution channels. And one of the real attractions of this acquisition for us is that it accelerates our growth in all three channels, as well as developing the proposition. It helps us move from a year of protection to a year of growth with the right culture, the right product set, and the right attitude. With regard to this transaction, so there are three areas that we really want to cover today. Firstly, the quality of what we're buying which is a long-established business. It was founded in 1834 as the Jersey Savings Bank, all the way back in the day. So it's long-established, clients introducing advisors based predominantly in jurisdictions in which we're already working. Secondly, I want to talk to you about the strategic and cultural fit, including what it does to extend our proposition and distribution. And then thirdly, I'll leave Ben to give you the good news about the all-round value add to the group and, of course, to the international business. So looking at the quality of the business on slide 6, this comes in 2 parts. Firstly, we've got a private client book of 1,200 individually managed clients, managed by private client advisors, a group of whom we're aiming to bring into the international business. As I mentioned, this is predominantly in jurisdictions in which we already work, so Channel Islands, the UK, South Africa, UAE, to name but a few. And it's all in MPS, so Managed Portfolio Service type model portfolios, which clearly translate to existing models which we already run. We'll work with Lloyds advisors to sign up these clients over the coming months. Given that these clients will remain as Lloyds banking clients, there's both a financial and an ongoing reason for this transfer to work well for Lloyds, and we're therefore confident that we'll have a high take-up. The second part is a Jersey domiciled funds business, again in 2 parts, with a 4-strong multi-asset fund range similar to our UK multi-asset funds, and a range of 3 fixed income funds, which are managed similarly to the investment portfolios which we manage through our Managed Strategies corporate bond team. This provides us with the multi-asset fund we've been looking for to enable distribution of multi-asset capability into various markets, and in addition, an extension to our distribution team and a significant extension to the number of advisor firms that we're dealing with throughout our key jurisdictions. And to give you an idea, we work with around 100 advisor firms. This adds another 50 to that list. The acquisition of this book and business therefore furthers our ambitions in all 3 of our targeted distribution channels, with an increase in the number of and relationships with both private clients and trustees through the book purchase and IFAs through the funds business purchase. On slide 7, so the strategic fit and the cultural fit, and the acquisition will only be truly successful if there's a strong fit between the 2 businesses, and I think that is the case in spades here. Clearly, it's true to say from the perspective of the business model, with the investment solutions fitting very well into our existing structure and distribution clearly aligned to ours. Additionally, we know we have a number of opportunities with the clients joining us. For example, with regards to financial planning advice, up to now they've only had investment advice. So, for example, we won't have talked to them, or they won't have talked to them about pensions, which could clearly add to assets under management over time. But it also gives a significant boost in terms of scale, taking us, if all assets come over, to something around 2.5 billion of assets under management. And that's key to building the margin of the international business. Pleasingly, from day one, we've got on really well with the people, and with COVID-19, we've had rather longer to get to know them than we'd anticipated, which is a good thing in many ways. As such, we're comfortable with the shared culture in terms of how we deal with clients and how we deal with employees, and this gives us confidence that both parties will fit in well at Brooks Macdonald. It also gives us real confidence that the partnership that we've agreed will bear fruit for us over the coming weeks, months, and indeed years, with specific services required by both businesses from the other, and a clear belief that we can add more value to the client by working together on their behalf. So in short, this is a transformational deal for the international business, and we look forward to updating you on our progress at future events. I'll now pass on to Ben for the numbers.
So I'm very pleased to be delivering the details of another high quality acquisition this morning, especially so soon after that of Connellan. First of all, an apology. I was hoping to be talking about rounded numbers today, but the final give and take of negotiations has meant that we've ended up with a fairly non-rounded number of 9.63 million. So the key terms of the transaction, starting with the summary box on the top of page 8, This would be an all-cash deal with a maximum consideration of up to 9.63 million. There are two components to the deal: a share purchase of the funds business and an asset purchase of the private client portfolios book. And this acquisition will be entirely funded from existing resources, and post-completion, we will continue to have regulatory capital well in excess of our requirement. So moving to the detail, starting with the left-hand column on the graph, and this is looking at what we are buying on an accounting basis, we are paying 2.5 million for reg cap and up to 7.13 million for intangible assets. Moving to the bottom of the second column and looking at it through a different lens, we're paying 4.65 million for the funds business, all up front. And on the portfolio book, we'll again pay up to 4.65 million up front. However, this will be prorated based on the level of client assets that come across. On top of this, we will also have contingent consideration of up to 0.3 million linked to client retention after 2 years. We also have further downside protection, with the consideration falling by £1 million if FUM is below £875 million at the time of completion. So now turning to the financial benefits of the transaction on page 9. As you can see, this is a highly accretive deal with significant financial benefits for the group. We are paying a PE multiple of just 4.5 times expected first year earnings. EPS will increase by 8 to 10% in the first full year of ownership, which will be FY22. And we expect to complete the deal pre-Christmas this year. Therefore, for now, work on the basis of around half that accretion in FY21. Very importantly, we have a very high degree of certainty on integration and benefit delivery, as all the hard work is going to be done pre-completion. To integrate the business will incur costs of up to £2 million, and as usual, these costs will be excluded from underlying earnings. On top of all this significant value accretion, we also expect further benefits to come from revenue synergies driven by the partnership with Lloyds and the additional IFA relationships acquired. So to wrap up, this is a great deal for the group and a significant milestone for International. So I'm now going to hand you back to Caroline for the conclusion.
Thank you, Andrew and Ben. So to conclude, we believe the opportunity to acquire Lloyds offshore wealth and funds business is a really exciting one for us as a business and also for our shareholders. As I hope we've been able to convey to you, it's a highly attractive opportunity for the group and for International. It's got a compelling strategic fit and a shared culture with that focus on the client. It augments our offering, expands our distribution reach, and all of which supports meaningful growth opportunities. And notwithstanding the quality of the core business itself, the longer term opportunities that we've talked about through the ongoing cross-referral agreement being put in place, supported that common culture will deliver benefits. So as you can see, the combination brings benefits to clients and intermediaries from both businesses. This acquisition delivers enhanced value for shareholders with material EPS accretion in the first year and the potential for upside from those revenue synergies. As we said up front, it's another significant step forward in achieving our growth ambitions. Now, a reminder, our Q4 trading statement is on the 16th of July, when we'll give an update on commercial performance. In the meantime, as I said at the beginning, our guidance remains as per the Q3 statement in April. Now, we're very happy to take your questions on this deal, and I'll hand back to Tamsin, who I think will coordinate that particular part.
Ben Bathurst from RBC Capital Markets. Go ahead and ask your question.
I've got a few questions if you don't mind. Starting just on the FUM development of the business, the Lloyds business that you've acquired. Just looking at some of the details you put out this morning, it looks as though that may have fallen in the past few years, the FUM there. I wondered if you could just share a bit more detail on what the picture has been there, what have been the drivers around the outflows, maybe, and if there's anything important you'd like to flag in that respect that we should be kind of considerate of. And also thinking about the flow picture going forward, what do you think the expectations for the growth of the sort of enlarged international business could be? And should that business now be looking to target growth in line with the kind of group targeted growth figures that you've guided to in the past, or might that be stretching it a little bit? And then finally, just looking at some of the details in the financials you provided this morning, I think the revenue was at around 10 million in 2019, for the newly acquired business, but you're now guiding to circa 7 million in your first sort of illustrative year within your group. I just wondered if you could just explain why you're guiding to that drop off of revenue in the business.
So I'll pass over to Andrew to pick up on the first part, and then Ben can add into your final question there on revenue specifically, and any other points that would be useful. So Andrew.
So in terms of the FUM drop off over the last few years, predominantly this has been part of the Lloyds International strategic plan. So they've gone through a de-risking of their business. I think it's fair to say, I'm not telling any secrets. Well, the banking sector has, as you'll be aware, over a period of time, and they've dropped a number of pieces of business. For example, they had a Gibraltar business, which they decided to discontinue a couple of years ago now. So most of it's been strategic plan. In terms of the flow picture, I'll pick that up as well, Caroline, if I may. In terms of the business which we're picking up from Lloyds, we expect that the funds business to continue, because the advisors, once we've got the advisors on board with the idea that Brooks Macdonald is a good home for these assets and we're going to manage them well, we see no reason why we wouldn't see a continuation of asset flow into those funds. And equally, although we've got to go through a period of bedding down the existing clients, we'd expect to see a flow of new business coming from the referral agreement, pretty much from day one. Slowly to start, as they get used to us, I would have thought. In terms of international as a part of the overall group, we're aimed at 8 to 10. I want to see double figures net flows.
Hi Ben. On the final part of the question, I think really, I mean, as Shep said, the business has been on a bit of a declining trend, but has now stabilised. So that's been a factor in the income forecast that we've put out there. So we're happy with the 7 million, and we think, I mean, we are also assuming a certain level of attrition that not everybody will come across. So that's what drives the 7 million figure. But as you can see, even at that level, with the restructured cost base, the deal is highly accretive, and it's a great deal.
And Stuart Duncan from Peel Hunt asks, what are the revenue margins on the two different sides of the acquired business? And will the fund management responsibilities transfer into the existing team?
So the revenue margin, blended margin, is just under 80 bips, as you can see. And that's, as the business is pretty much split down the middle, 50-50, that's pretty much 90 basis points or thereabouts for the private client business, and about 70 basis points for the funds business. And in terms of the insourcing of investment management, clearly that's an area of our expertise, so that will happen pretty much on day one.
Andrew, do you want to expand at all on the setup of the business from our perspective going forward?
Yeah, well, particularly on the investment management side, as Ben says, that the assets and the management will come straight into what we do already. The multi-asset that we're bringing on, which is all of the discretionary portfolios and a third of the funds, literally will move straight into our multi-asset team here. And the portfolios will be managed in line with their existing mandates, which link into the risk-based mandates which we already run. So no additional headcount required. From a fixed income fund perspective, we run fixed income portfolios through our corporate bond team already. These are corporate bond mandates which we'll be taking on, so we'll be managing that within that team as well.
And we have a question from Paul McGuinness from SureCap.
It was just a little bit more detail on the nature of the 2 million of integration costs. Exactly sort of what areas are they going to be coming from? And then Ben, just to confirm something I think you said in the comments, did I take it that you're saying around half of that sort of 2.5 million expected profit would be actually deliverable within the year to June 21, assuming completion around about the end of this calendar year?
Thanks, Paul. Hope you're all right. So doing it in reverse order. So yes, that's correct. We get half in FY21, assuming we complete before Christmas, which I think is very realistic. And then the other point in terms of the the integration costs. Clearly, we'll aim to keep these to a minimum, but the bulk of the costs will be going towards working with Lloyds to get the operations for the funds business outsourced to JTC. So that's the driver of the cost there.
We have a question from William Tamworth from Artemis.
Hello. A couple of questions. Firstly, are there any key people that you need to retain as part of this transaction? And if so, how are you planning on doing that? And secondly, what's the capital headroom that the business has after doing this cash transaction?
So in any transaction where you are bringing over clients, the key people are going to be the relationship managers who have looked after those clients, sometimes for a long time. It's our intention to bring over an experienced cohort of those relationship managers. Clearly, they haven't known about this deal until today, so there is a risk there. But with Lloyds, we've put together what we think is a really attractive package. We have been in contact with senior managers who agree that this is an attractive package, and they're confident that we'll bring over the individuals that we're looking to. So we're confident, but there's a risk there that we don't get all the people that we're looking for.
So we don't, as you know, we don't disclose our Pillar 2, so we do everything versus our Pillar 1 requirement. But we would have, and it does depend when the deal completes and whether we've got first half next year audited profits in the numbers. But assuming we don't, we are pretty much 200% of our Pillar 1 requirement, so well in excess of where we need to be.
And we have a question from Marcus Barnard from Hardman.
Can I just ask what your capacity to do further acquisitions would be this year? I mean, I know you bought this from cash, but do you think this will really tie up management resources? I just wonder what your thoughts were on that. Thank you.
Let me give a sort of high-level answer around the strategic side of things, and then I'm sure Ben can probably add some thoughts to that. Well, hi Marcus. Hope you're well. And I think in terms of where we are, as I talked about, and as we've delivered through our strategy, we've built up capability in the business to drive the organic growth agenda, but also to ensure that we can take opportunities when they arise around the inorganic. I think we've got a good team in place. Our experience with Connellan is it's going well, it's progressing well despite COVID-19, and we had a good process there. Now, we always learn from that, and we'll apply that learning to this one. So we will definitely be keeping an eye out for other opportunities that are there. We've got a high bar, which we've talked about again, and we will make, as part of any decision, a judgment call as to our capacity and ensure that we can land it well. But we do see inorganic as something that complements our organic focus as well. So Ben, I don't know if you want to add to that.
Yeah, a couple of points. Hi there. A couple of things. I mean, I think we've now, having done 2 in such short order, developed a pretty well-oiled machine at a corporate level to do this, and clearly that part of the machine is now finished. So also, secondly, just to say that the Connellan integration is going very well, and we'll update you in July. But again, that is also falling away. This piece of work is obviously mainly compartmentalized in international. Therefore, in the mainland, we do have capacity. So I think, net, yes, we do have the capability and capacity to push on with other deals if and when they come up.
I think that's the end of the questions. Caroline, do you have any closing remarks?
Great. Thank you, Tamsin. Well, I just want to thank everybody for joining us. Not quite the same as in person, but hopefully we'll have the chance to invite you to our new offices in Lombard Street next time. We were in all of 3 weeks before COVID-19 lockdown started. So we're looking forward to getting back in due course, and we look forward to seeing you there. Thank you very much, and thank you for joining us.